So in the last video, we covered what prediction markets actually are. These strange, fascinating places where you can bet real money on whether something will happen. Election, interest rate decisions, tech announcement, almost anything with a clear yes or no outcome. But here's one thing we didn't dig into. Once you're inside one of these markets, staring at a number on your screen, how do you actually read it? What does that number mean? This video is a part of a completely free course on how prediction markets work. Every module is available at predictionist.com. Link is in the description. So let me start with the most important idea in this entire course, and I'm going to say it plainly so it lands before complicated. In a prediction market, the price is the probability. That's it. That's the whole thing. So a contract price at 35 cents means the market collectively believes there's a 35% chance that event happens. Not some abstract betting line, not a number a bookmaker invented, a direct translation of crowd's belief into a dollar figure. Every contract lives on a scale from 0 to $1. 0 means the event didn't happen. The contract is worthless. $1 means it did happen. You collect the full payout. Everything in between is just market's life estimate on where on that spectrum we're headed. It's a cleaner system that most people realize. And once it clicks, once you internalize that price equals probability, the whole game changes. Now, every market has two sides, a yes and a no. And here's something that trips up almost every beginner. Those two prices always add up to exactly $1. Always, no exceptions. If yes is trading at 65 cents, the no is trading at 35. If yes shoots up to 82 cents, no drops to 18. That's not a coincidence, it's a mathematical rule baked into the structure of these markets. The two sides represent the only two possible outcomes. One of them has to happen. Together, they cover 100% of the probability space and equal to $1. Why does this matter in practice? Because it means you have choices. If you think a yes contract is overpriced, you don't have to short it. You can just buy the no. Same view, different door. On some platforms, they're literally the same trade under the hood. Let me make this concrete with a real example. Say there's a market asking, will the Federal Reserve cut interest rates in its June's meeting? You check the market and you see yes trading at 42 cents. That means the crowd currently gives a 42% shot. More people think the Fed won't cut than think it will. Now you do your own analysis, you read the latest Fed minutes, you check whether inflation is running. You look at the recent economic data and you land somewhere different. You think the real probability of a cut is closer to 25%, not 42. And if you're right about that, the no contract at 58 looks cheap. You buy it. If the Fed doesn't cut and the contract resolved to $1, you pocket 42 cents on every dollar you risked. If you're wrong and they cut, you lose your 58 cents. That's the fundamental bet. You're not gambling on whether something happens, you're gambling on whether the market estimate of something happening is accurate. That distinction is everything. So, what actually moves prices? Well, three things mainly. The obvious one is new information. A poll comes out, a speech happens, an economic report drops. Trader rushes to update their bets and prices shift almost instantly. There's a research on 2024 US election market showing that prices react to major news events within minutes, sometimes even seconds. But the interesting thing is that they don't always stabilize immediately. There's often a lag while traders argue about exactly how much the new information should move the needle. That lag is where sharp traders find opportunities. The second driver is sentiment, and this one is a little bit messier. Sometimes prices move for no good reason. A big account posts something of an opinion on X, a narrative spreads. People get swept up in recency bias, overweighting whatever just happened, and a contract drifts away from where it probably should be. These moves tend to correct themselves, but not before someone gets burned chasing them. The third is liquidity, meaning what happens when a large trader, sometimes called a whale, enters or exits the position. If someone drops $500,000 into a yes contract, the price jumps, not because the underlying event became more likely, just because of the buying pressure. If nothing fundamental changes, that price probably is going to drift back. But in the short term, it can look like a signal when it's really just noise. Learning to tell those three apart, information, sentiment, and liquidity, is one of the actual skills this course is building toward. It's not obvious at first, but it becomes a pattern recognized over time. Now I want to talk about something that doesn't get enough attention in beginner content, the bid and ask spread. When you look at any contract, you'll notice it doesn't have one price, it has two. The bid, which is the highest price someone is currently willing to pay, and the ask, the lowest price someone is willing to sell for. The gap between them is called the spread. The spread is a cost, a quiet, invisible one, but real. So if you buy at 42 cents and immediately try to sell, you can get only 38 cents. You already lost 4 cents per contract before the market moves a single tick. For casual traders, a 4-cent spread on occasional trade is fine. But if you're making dozens of trades or trading in markets where your edge is thin, the spread starts eating your returns in ways that compound fast. The move that most beginners don't know about, instead of hitting the ask price immediately per market, place a limit order somewhere between the bid and the ask. You might wait a little longer to get filled, but you'll often save 2 or 3 cents per contract. Over time, that adds up to real money. And there are fees, which vary widely across platforms, way more than most people realize going in. Polymarket, the largest decentralized platform, embeds its cost in spread and in blockchain transaction fees. Total friction is typically under 1%, but it has changed recently. Kalshi, the CFTC regulated exchange, charges somewhere in 1 to 3% range depending on the contract. And then there's PredictIt, the granddaddy of US political markets, which takes 10% of your profits plus a 5% withdrawal fee. A strategy that easily pays on Polymarket can be a consistent loser on PredictIt with the exact same trades. The practical lesson: before you trade anywhere, calculate your expected value after fees, not before. A trade that looks profitable on paper can turn into a net losser once you factor in spread, platform fees, and on some crypto platforms, even gas costs. This isn't a technicality. It's one of the most common ways smart beginners bleed money without understanding why. Before we close up, there are 3 mistakes that I want you to keep in head as you start looking at real markets. First, a low price doesn't mean a cheap bet. A contract trading at 5 cents isn't cheap. It represents 5% probability event. If the true probability is actually 3%, you're overpaying by more than a half. Think in probabilities and not prices. Second, don't fixate on yes. Buying no on overpriced long shots has historically been one of the most reliable edges in these markets. We'll get deeper into why in a later module. It comes down to a systematic bias called the favored long shot effect. For now, just remember the other side of the market exists and is often more interesting than it looks. Third, always read the resolution rules before you trade. The contract doesn't just have to be right, it has to resolve cleanly. There have been cases where traders were correct about what really happened in the world and still lost money because of how the resolution criteria was written or disputed. Boring details, but real consequences. Alright, so here's what we covered today. Price equals probability, directly, mathematically, always. Yes and no always sum up to $1. Prices move because of information, sentiment, and liquidity shifts, and telling those apart actually matters. The bid, ask spread, and platform fees are real costs that erode your edge in ways that sneak up into you. And a cheap looking contract isn't necessarily underpriced, it's just low probability. In the next video, we get hands-on. We're going to walk through placing your first actual trade, step by step, setting up an account, funding it, and reading an order book. No more theory, just the thing itself, so see you there.